You seem to get quiet at the right time. All right. We are, I am told, going live now. So let's go ahead and let's see if this works. IT, are you there for me? No. Oh no. This is a catastrophe. How was everyone's ride? I'm dying up here. Okay. Sorry, I don't know if you could tell. It's okay. We're texting Victor in real time. I'm going to read you my texts as they come in. That looks bad, Steve. That looks so embarrassing. It is. He said 1 sec. He's resolving the clicker. There we go. That's a good sign. Victor's the man, by the way. So. And Dustin, just FYI, usually we have that TV on up there so you can actually see what you're talking about. Oh, here we go. What does he have to say? Oh, God. Take it off. Take it off. Take it off. Victor, save me, buddy. I know. I hope he can hear me. All right. Tell him to abort and that we're moving forward with the presentation. If the clicker works. I'm going to let you in on a little secret as to why this is happening to me, why my company has put me in this position. Half the people in this company don't like me. The other half hate me. So that is why I am standing here live, streaming in front of you in a hot room, looking like this. Okay. Dude, we're there. All right. Now, okay, so we got that back, which isn't going to work. We have no volume. I can lip sync this for you. Invest with Quest Trust Company. So what that was, by the way, just so you know, we actually did do a TV commercial in Houston a couple of months ago, one of which starred yours truly. So we thought it'd be fun to share it with everyone since you didn't get to see it here in the Dallas market. But anyway, sometime that'll work and we'll be able to coordinate that a little better. Anyway, thank you all for being here tonight. So happy that so many of you have made it out. My name's Steve Sabaji. I'm the regional sales manager here for Quest Trust Company in the Dallas office. And I want to welcome you to our social this evening. We have a great speaker tonight. He is, in many ways, he and his company are old friends of Quest. We met a few months ago and kind of reintroduced ourselves. And so it's great that we have him and that he was willing to come back and speak to us again about some of the opportunities that he offers, but some of the education that he's going to talk about direct real estate investing versus using pooled funded trusts like REITs. So Dustin's going to be up here in a minute and talk about that. First of all, though, I just want to hit some of the announcements real quick before we start. First of all, if there is any information that you want to learn about Quest or self-directed IRAs, the QR code that you see there scans to the calendar for the IRA specialist team. It's a great way if you want to just block out a little time and learn a little more, ask some questions. It's a simple way you can just schedule a consultation and somebody will give you a call when it's convenient for you. We are still running what we're calling our rewards for deposit program, meaning if you bring in certain amounts of money, credits will be posted to your IRA account. Now, the numbers look like they might be a little unusual. However, the numbers actually coordinate to various fees associated with your Quest account, not the least of which is that $125, which is the cost of a transaction. That means bring over some money, your transaction is on Quest. Next month, we're going to be changing things up a little bit. So in place of a presentation like we're doing tonight, where we have the intro, we try to have a really great TV commercial that we show you that will just awe you to no end. We're going to do straight up networking next month, kind of like we did in December for our ugly sweater party. Next month, it's going to be pure networking. So it'll be people here. We have this nice luau theme that we're going to be doing. So you're very highly encouraged to wear your greatest Hawaiian shirt. We are in talks with our lovely bartender, Haley, back there, who has always been so great with us, who informs me she does know how to make a Mai Tai. So we may change things up just a little bit and have some themed drinks as well, in addition to some great Hawaiian food that we're going to plan for. So it'll be a little different, but it will be also a lot of fun. Hope you will put that on your calendar. Already seeing a lot of interest in that already. All right, multi-family summit coming up in August. You've heard a lot about this, I imagine. We are now releasing the lineup. You may recognize some of those faces up there. A couple of people you, again, may know. Let's see, I see up there some people I know. I see Shinoa Grove there on the far side there on the, that would be your left. Let's see, there's Adam Barr toward the middle. I see one Brad Sumruck, who is going to be speaking at our conference, in addition to Arlene Garza. And I believe that's Kira Golden, too. So already got a great start, a great lineup of people who are going to be presenting at this event. Tickets are being sold now at early bird pricing, I might add. Anybody who is looking to get a ticket for this event potentially, see the young man shoving a lot of food in his mouth right there in the back named Grayson Carter. Say hi, Grayson. Yeah. All right. And with that, I'm going to turn it over to Dustin. Again, Dustin Gabriel, he's been in the investment area for a long time, real estate related, done a variety of different things. Again, going to educate us a lot on the difference between using multifamily deals versus pooled multifamily investing, pros, cons, and everything you need to know about it. Dustin, no one can introduce themselves better than themselves. So with that, I'm going to turn it over to you.
All right, thank you, Steve. Can everyone hear me okay?
Everyone can hear me.
All right, great. Put my phone away, just in case it goes off accidentally. So my name is Dustin Gabriel. I was born and raised here in Dallas. So I went to Allen High School. Any Allen Eagles? Got some Allen Eagles over there. It was before the Kyler Murray days. We were still a pretty good football team, though. We built that foundation for them. That's what we tell ourselves anyway. And then, but I currently live out in South Lake, and so I'm with the Casoro Group, and it's a family office private equity firm headquartered in Austin. And they started, very experienced sponsor, probably one of the more experienced sponsors in Texas. I mean, we've been investing in multifamily since the early 2000s. And then on top of that, so they're more vertically integrated. So we have a property management company, a construction management company, utility and billing company that they've had since the early 2010s. So they have just really deep knowledge and experience when we're going into these investments and what we're looking at and what we're wanting to do. But we also have, more recently, we opened up, I guess a few years ago, we're about to relaunch it. It's a public non-traded REIT, and so it's called Upside Avenue. And that just kind of opens up, we'll talk more about the REITs, obviously, and a little bit more about my background. So I more recently came from a structured finance company owned by Apollo, which is one of the largest private equity companies. And before that, I was with Banco ZK in the Real Estate Specialties Group, which is one of the largest construction lenders. One of my old colleagues in the back there. Also, he's a GP guy too. Good to talk to him. And then before that, I was on the sponsorship side, on the GP side. We did suburban Class A office developments. So like my first deal was a brand new Class A, like ground up construction office building. And I didn't even know how to spell pro forma, but I still went for it anyway, and we got it done. We executed. And so we did a couple of those buildings, and we did let's say a land assemblage for a mixed use development we're looking to do. And then we did a multifamily rehab. I've also, this is all like kind of personal stuff. Then I've managed some retail and a shopping center. And so that's kind of my background a little bit. And we can go ahead and see if I can get this. So I usually have a little TV here, but I'll also kind of check here. Maybe clicking the right button. Maybe. Clicking the wrong button. There we go. Yeah. That's all right. I can just keep peeking over here, right? I play DB. Always looking over your shoulder a little bit. It's like kickoff team too, going down, head on a swivel. All right, so this is my disclaimer slide. So this presentation, obviously it's for informational, educational, maybe a little bit some entertainment value as well. But so I recommend you, before you make any investment, talk to whoever your advisor is. If that's yourself, talk to yourself in the mirror. Let's see if I can. Maybe it's like a little delayed. Oh. Okay, hopefully it stays there a little bit. Okay, so we see these headlines here. I could just keep filling these things. There's so much new stuff coming on like every day. It seems like there's something news, related to something like that over here. So, you're interested in investing in real estate. So we have like some of these headlines here. They're just crazy. So this top one here, so we keep hearing about this wall of looming debt maturing here in the next few years. And so out of that $1 trillion, there's like hundreds of billions of that supposed to be maturing in the next year or two. And so it's just going to be interesting to kind of see what that does with the market. It's going to create some opportunities, but it's also going to create some stress in the market. So it's going to be a ride here in a little bit. It's kind of what we're thinking. And then you look at this next one down here, that Southridge Mall. That's out in Wisconsin, and that is owned by Simon Property Group. And Simon Property Group is one of the largest owners of commercial real estate, and they're also a REIT. And then that's going through the foreclosure process right now. And so that's going to JP Morgan right now. And then you look at those foreclosure spikes, and I just kind of get those like great financial recession vibes when I keep hearing those like foreclosure spikes. That's just like, I'll never forget that moment, because that's where I got my really good like gut punch. It was during that on some of my personal deals during the financial recession. So I've learned about how awesome it is getting into commercial real estate, but also on a personal level, I know how like, man, boom, just poof, just disappears just like that too. So it's interesting how that goes. And then you got this one at the bottom here. This one's a little bit closer to home. I think this deal was a portfolio of like 4 different properties, and it was, I think, mostly like B and C, maybe mostly C. But this is just a good an example of an inexperienced sponsor where you had some bad deal structures, and the investors just got smoked here on this bottom one. And it's also a good example of the double-edged sword of leverage. So this deal, I mean, it had high leverage. I'm just thinking about those investors. You know, they probably received the offering memorandum. They probably got the pro forma. They're looking at the returns here, comparing it to other investments that they're looking at. Like, man, the returns here, man, these are juicy returns here. And I'm gonna go for this one. And so they chose that one because the returns just looked higher on paper. And at the end of the day, because the way the deal was structured wasn't structured very well. Sponsor wasn't the best sponsor, and lost all their money. And so I kind of look at those, like these two deals, the Southridge Mall and that Houston deal. So they're little case studies there. So you have Southridge Mall, you have an institutional sponsor, someone who's, you know, lots of experience, got all their processes and procedures, one of the biggest players, biggest names out there. But then they're in the wrong asset class, they're in the wrong location, and just bad market timing. And at that deal, I mean, everyone's just losing everything on that deal. And then you got this Houston deal where you have the right asset class, and the market's a little debatable. I know Houston's kind of been boom or bust, but I mean, Texas is Texas. I mean, people are still flocking to the main MSAs. And then you have just like a bad sponsor on that deal. So I kind of think about, you know, what would happen if you kind of plugged in some different things, some different players on a couple of those things. Like say you take that deal up in that Southridge Mall, you plug that somewhere here in Texas. I mean, you kind of got an example of that. I mean, we got Grapevine Mills Mall, which is owned by Simon as well. That mall has been around forever. I mean, since I was in, I remember seeing the commercials when I was in, I think like 9th grade, 10th grade, you know, like the 90s or something like that. Seeing that mall, like they show the tower of the mall, it's supposed to be like real big or whatever. And that thing's been around, still performing well. It's been around for a while. But then you have those apartments, you know, B and C properties. I mean, a lot of the stuff we manage is B and C. A lot of the people in here, when they manage deals, they're B and C properties, but you don't see them going to being foreclosed on. So it's like you trade in one or two of these components can really make all the difference in your deals. So it's just something to think about as you're making investment decisions. Yeah. So on the Houston deal, I mean, they loaded up with debt. So they had probably as high leverage as they can get. I think it was like 80% LTV or something like that. It was floating. And then you have pref on top of that. And so if there's any sort of like, I mean, the deal just has to be running perfectly for everything just to work right. And so when interest rates started ticking up like crazy, I mean, their cash flows, it's just, you're not covering the debt service anymore. And it keeps going on for an extended amount of time. And it's like, what do you do in that situation? It's like, how do you get out of that? They're trying to do capital calls. They're trying to get investors to put more equity in the deal, and no one was willing to do it. I mean, it was a sinking ship at that point, and it was just, you want to get that fixed rate debt, or you want to get some interest rate caps, and just be careful on leverage, because if you get a lot of leverage, yeah, you're going to add more juice to your returns, but you got to time things perfectly in the market for that to really work out for you, and hopefully, if you do get in that situation, hopefully you have the capital to put into it so you can cover the debt service, cover your payments and your expenses until the market kind of stabilizes, or until you can finish whatever your value add plan was. I don't know exactly what their game plan was, but I'm assuming there was some sort of value add component in there. Did I answer that for you? All right, good deal. Like it. All right. So we'll get into this presentation. I mean, really, we'll be talking about kind of REITs versus direct real estate investments. I want to hit on several different points. I mean, mainly, the main points I want to hit on is the investing process, the returns on both, and then the tax advantages. So we can start off on really what is a REIT. So REITs, it's a real estate investment trust. And so in 1960, President Eisenhower, he signed the Real Estate Investment Act. And so this allowed investors to invest in diversified, large portfolios of real estate through the trading of public units. And so you got several different types of REITs. And so you got the public non-traded REITs. So those are open to accredited and non-accredited investors. And then publicly traded REITs, they're kind of the same thing. They're open to both. But then you have private REITs. Those are accredited investors only. And then there's some differences in some of the governance. So publicly traded REITs, I'd say they have the most SEC governance because, I mean, publicly traded, they're listed on a lot of the main exchanges. And then private REITs, they're not regulated by the SEC. And public non-traded REITs, they're kind of somewhere in the middle. So they have to file and they're regulated with SEC. And then you have the equity and mortgage REITs. And so equity REITs, Simon is an example of a publicly traded equity REIT. And then you have Arbor, who's many of us are probably familiar with Arbor. They're an example of a mortgage REIT. So the REIT I help manage, we're a public non-traded equity REIT. And so we focus mostly on multifamily and other kind of high growth markets and across the other Sunbelt states. I mean, direct real estate investing, I think we all know what this means. And I mean, it really just kind of depends on your role as a GP, as a general partner, or as an LP, as a limited partner. I mean, this is really done on a deal-by-deal basis. I mean, so if you're the GP, I mean, you're sponsoring the deal. I mean, you're doing all the work, and you're finding it, you're structuring it, you're raising the debt and equity, and then you're managing it. And if you're the LP, I mean, you're just kind of riding along passively. And you're making a capital contribution, but you're not involved, working the deal or any of the day-to-day decision making. It's moving a little bit smoother now, Steve. So I don't know, maybe you got it warmed up a little bit. And so the investing process for REITs it's very simple. I mean, for publicly traded REITs, it's typically done through your brokerage or your financial advisor. Our public non-traded REIT, it's loaded with a lot of investors. A lot of them have we've worked through like their self-directed IRAs. We have many Quest Trust investors in ours. And so it's very simple. For example, investors, like they go to our website, they see a link, I think it says like invest now. They click on the link, they'll show there'll be some documentation, and they just kind of read through the documentation, they sign it, and then it starts it's like a DocuSign stuff, and then they'll start the onboarding process from that. And so kind of like the same thing as like when I'm onboarding investors just in general, whether it's for the REIT or if it's for direct deals or for some of the funds we're looking to raise. I mean, I'm probably going to jump on a call or Zoom or Teams meeting or come meet you in person, and just because I just want to make sure it's a fit for both parties. Because I mean, real estate investing there's always some risk to it. Doesn't matter like how experienced the sponsor is or whatever it is, as I kind of pointed out in those examples. And so when the markets are changing and shifting, and because things just happen, things happen with your distributions. Like it's not always going to be the same. Your dividends aren't always going to be the same. So I want to make sure you just understand, like it's not all rainbows and lollipops in the real estate investing world. And so the investing process is much more complex in direct real estate investing. I mean, I can just give you just one example of some of the complexities. So we have a deal closing on Thursday, and I think we have like 19 different entities on our org chart, and it just keeps moving like every day. There's like we're restructuring stuff. We're still like massaging things, like even to the closing, like it's going to change a little bit tomorrow too. And then you have a bunch of other entities rolling into those entities. And so, I mean, you definitely got to have some specialized knowledge because you have to guide your attorneys. You can't just depend on your attorneys on the structuring because they understand kind of like some legal things, how to do that, but they don't understand the business aspects when you're structuring a deal. So that's just one of the many aspects you got to worry about. I'd say benefits of REIT investments. I mean, the diversification is definitely a major benefit. I mean, you're investing into a vehicle that already has a pool of assets. They're already generating cash flow. And then on liquidity, I'd say public REITs are probably more similar. They probably have the most liquidity on public REIT side. It's very similar to like stocks, but but you kind of look at that. I saw some report, I think it was from BlackRock last year, where they're talking about stocks and bonds, how they were both down for the first time since 1969. And so publicly traded REITs, yes, they have the most liquidity, but then they're tied to the kind of day-to-day market volatility. So it's like, yeah, you can get out of it, but then it's like, well, where's that price going to be at when you're trying to exit? Probably, I think I saw somewhere it was down like 25% last year. So, I mean, you just have to, yes, you can get some liquidity on things, but it's just in general, like when you're trying to exit a deal, like what's the timing of the deal? I mean, where's that value at? Because like right now, like if you were to, like if a bank, if we go back to our banking days, me and Vinny back here, we go back to our banking days and we're stress testing some of our deals. When we're checking it on a quarterly basis, we're kind of arbitrarily coming up with that value, but it's like the sponsor's not looking to sell that. They're not looking to exit that time, even though like, well, we see the value's changed here because that's what all the market is doing around it, but it's just not part of the exit strategy. So you still have to figure out when that is and time things on the market. But one thing I would say that kind of the other types of REITs that they have, they do have some more arbitrary control on kind of on redeeming shares and also controlling the share price, kind of to help protect. That's a mechanism to protect investor capital during any recessionary times like what we're probably heading into right now, or already in that we don't even know yet, right? We are in the matrix. And so like some of the cons I'd say of REIT investments, I mean, it's really the lack of control. I mean, this is similar to being a smaller limited partner in a deal. It's really dependent on the team you're investing with. I mean, every deal out there is dependent upon the market. It's, but I'd say obviously publicly traded REITs, they're definitely going to be the most volatile. Obviously the pros of direct investments. I mean, yeah, if you're sponsoring the deal, you're controlling the deal, doing all the work, you have the potential for the most upside to achieve the highest returns. And that's if you can hit the performance hurdles. Drawbacks, I mean, right now in today's market, I kind of hit on a little bit. I mean, so they're going to require more equity. And so this is true, especially in today's market. I mean, so if you're trying to sponsor and put a deal together right now, I would expect to put in like 40 to 50% equity in the deal. I mean, you're going to have to you're probably going to have to structure finance the deal. You're going to have to use some sort of gap financing tool like mezz or pref or something like that in the deal. That's one of the deals we're closing. We did have to put a small pref piece in there. We usually don't do a lot of pref, but this one we had to just because it was a big equity raise. And then you have and then also the property management. So you do all this work. I just think about this. I mean, you do all this work. You find the deal, you structure the deal, you do all the due diligence. I mean, there's so much work that goes into like just finding the deal, getting it structured with the debt and the equity pieces. So much work goes into that. You have so many people, so many different attorneys. Everybody has an attorney, teams of attorneys closing a deal, and you finally get it across the finish line, and then it comes all down to your property management company. And so, man, like they can make or break your deal. Like I've seen instances where, I mean, we do all these things. Like when back in my banking days, I saw this on sponsors. Great sponsor, actually, we're a REIT too, and they were a really good sponsor, really high quality asset. They executed on the asset. They did such a great job, and then they had a really big name property management company coming in. I mean, we all know the name. I'm not going to say the name. But everyone knows that they had great processes and procedures. They just do everything. They have all that. But then they had the C team. It wasn't the A team, it wasn't the B team, it was the C team. So they struggled on their lease up and they're having a hard time. And so like they couldn't hit their hurdles. And so we just kept sweeping cash flow, and they couldn't distribute anything to their investors. And because of just all these inefficiencies, and it's just, so you just have to be mindful of when you're picking a property management company. Yeah, like you might pick like a great name, a great reputation, but you want to figure out who those people are actually managing the property. Who are they? talking to your potential tenants, who are like, just what kind of attitude do they have? Like, how do they engage with people? How do they interact with people? So you have to get down to that level. And are they going to actually execute on the business plan? Are they going to follow processes and procedures on a regular basis? You have to get down into the nitty gritty. So that's what I think that's the reason why we probably started our own property management company. So we just have more control over all those things. It just makes it easier for us and our investors. All right, so returns, I'll get in more detail too in later slides on this. But I'd say, so returns, they're paid in the form of dividends. Publicly traded, they're going to have listed shares similar to stocks, but obviously they're more exposed to the day-to-day market volatility. A non-traded REIT typically goes off of what's called the net asset value, and as the main metric for this, and then this can be calculated quarterly or annually. And then you have your returns for direct investments. If you're sponsoring the deal, you obviously have the potential for the higher returns, but you need the time, the experience, the team, and the market to show up for you. Because as we kind of pointed out on the earlier slides on that recent headline slide, if you have one of those pieces out of whack, it can tank your deal. So it's just something to think about. And then as far as returns, kind of comparing these two, I can kind of speak to kind of what I've seen on ours. So the dividend yield for our REIT has been 4.8% through 2022. And then you kind of look at, lately in recent years, what have cap rates been going for? Like 4 to 5%. I think before the capital markets meltdown, I even saw some cap rates in the 3s. I think I heard of some sub 3s, like in California or something, but I don't know if I ever saw anything like that trade here in Texas. But so that just kind of gives you an indication of kind of what you could expect for a return, like in a given year. So it kind of compares the two there. But I just say, like, both vehicles, they provide the potential for double-digit returns. All right, so tax advantages here. REITs, so they're required to distribute at least 90% of their taxable income, and they avoid double taxation. And so this is the main reason why they are typically higher on the dividend yield as compared to alternatives. And so many of our investors that utilize groups like Quest Trust, obviously, kind of when investing into our REIT through their self-directed IRAs, just because it provides some additional tax advantages, which one of their advisors could probably speak to you in more detail about. But REITs, they're just much simpler. So they use a 1099 form 1099 as opposed to dealing with the complexity of a K1. Tax advantages in real estate in general, they're pretty spectacular. I think, obviously, I'm bullish on real estate, so all things real estate. But it can get pretty tricky on the 1031s. So when you're trying to find a like-kind property, so I would just recommend, you have a team of professionals helping you kind of navigate all these things so you can maximize the benefits of your investing. And as far as access, it's just much easier and simpler to get into real estate investing through a REIT. They just provide a broad market access with smaller investment amounts. It's typically going to be like a couple $1,000s to invest into a REIT. I'd say most REITs, some publicly traded REITs might be less than that. I think some private REITs, I think they're going to be a couple $100,000 to get into some of those. But while direct real estate investments, they offer the ability to target specific properties and markets kind of based on investor preferences and strategies. All right, so, in summary, I'd say REITs and direct real estate investments, they both offer distinct advantages and considerations for investors. The choice really depends on the individual, investment goals, the risk tolerance, the preferences. I wouldn't say it's really one versus the other. I'd say you can do both. So our group, like we've invested millions in both. So you can do both. It's not like I'm just going to do this or that. So that's just one thing as you guys are making your investment decisions. But hopefully this is a good summary of kind of like the main points I wanted to cover there. And thank you.
Good stuff here. Can you turn up the lights here real quick for us? We felt so bad because we never know how the speaker looks on camera because we turn the lights down so you guys can see the screens, but we never know we know that the people can't see you. So
yeah,
this is our dilemma.
Nice and warm over here. That's what I'm feeling.
That's part of the reason, personally, if it's me, I don't want people seeing me right now. So anyway, so you know what we're going to do? We're going to close the curtains behind us. That's how we're going to solve that problem.
Yeah.
Grayson Carter, everyone. All right. Any questions on what we've been talking about here? I think you touched on a lot of interesting points. I especially like the analogy that you made early, and I've made it myself, with comparing it to traditional investments, where you're talking about like buying one stock versus buying a mutual fund, and the diversification and the, kind of way you can spread risk a lot more easily, and maybe even in a more effective way in terms of your buying in. Did you want to expand on that any further? Like, talk about when you talk about like a REIT, like I've just come across some folks recently who've talked about like how some of them specify in a certain type of real estate. Some of them have broad types of real estates. Is there any additional context you want to give to that, or?
Yeah, I mean, it's because we have, like in our language and our REIT, I mean, we mainly been focused on multifamily. I mean, we're going to be expanding in some different asset classes that we see those opportunities just because of the team that we have in place. We feel like with the team members we have the experience to expand in maybe some other asset classes like student housing, maybe some senior living, and we might be looking at some other things as well, some build for rent. And we have a lot of people on the way our group is, we can do more ground up stuff as well. So yeah, we're gonna be focused on a lot of the existing, but we're also gonna be looking, because we've owned some land for a long time. We're also looking at some other parcels. So our basis and some of the land is really good. And so it makes sense for us to go for, we've built things before. We have a history of that. And so there's just a lot of different things you can kind of mix in that bucket of diversification. And so for our REIT, as we grow it, so it's not just gonna be limited to just investing in our deals. So we're looking to be more of a capital allocator as well. So then I can just hit all buckets of everybody in here who's like, everyone's ever looking for capital or looking for deals. And hopefully we can just solve all that for you guys, and with some different things. So we're hoping to get it big enough to where we just have different options. So I'm always looking to connect with, good operators as well. And because it could be future partners on some different things. We could be looking to invest, or we could JV on some things. But I mean, that's the diversification aspect of it is, I mean, I think that's fantastic. But also, I mean, you want to be mindful of, where exactly are they investing? Like, you don't want to be investing like Simon Property Group. Like, yeah, they're a great sponsor. You want to invest with them. But then if they got a bunch of deals, other things in like Wisconsin or other markets where they're struggling, they can kind of balance that out. That's the part of the diversification part. That's great. But it's like, you want to be focused on some of these high growth markets. And so there's usually like, you can see kind of what assets the sponsor is invested in whenever you're making a decision.
So that was a question that came in where it was talking about not just diversifying from the standpoint of the types of real estate, but also the geography. Mm-hmm. Where are you guys? What market interests you the most, or markets, should we say?
Yeah, I'd say, I mean, we're heavy in Texas, probably along the I-35 corridor. I mean, we have mostly in Dallas, Austin, San Antonio area, kind of everything in between. And we do have, we know Houston real well, so there's certain pockets we'll play in there. But Houston's, it's an interesting, I just laugh at he understands. Yeah, it's an interesting place. So you just have to know certain areas. And we have, great property management staff as well, but we're looking to expand in more Sunbelt states. We're targeting Florida and the Carolinas. And so we'll be expanding out there here pretty soon as well.
Interesting. David, you got a question?
How does a non-publicly traded public REIT work? Like how do people invest? What's the restrictions around that as you touched on that point?
Yeah. So publicly traded, obviously it's listed on the main indexes and all that. So public non-traded, it's, we're usually not going out to, I guess we could go to all the broker dealers and things like that and get it on all the platforms. At some point we might do that. I'd say most of it's been kind of just word of mouth on a lot of things we do. We haven't done a whole lot of marketing for it. We'll probably start launching some larger marketing campaigns. It's just easier. You just go to the website and it has a button that says invest now, and you just kind of follow the prompts on there and it kind of leads you along. And like we had some people, they'll just review it, like, because we can kind of track and things like we have like some sort of tracking mechanism. I gotta get a little smarter on that. But they just read the documents and they sign it like that day. And it's pretty quick. It's normal. You got your subscription agreement, you got your offering circular. So you just want to kind of, I would recommend definitely reviewing some of that. You can have an advisor review it too. I'd say a lot of people we have don't always do that because they're just putting in. I guess we do have some who put in like $500,000 and $1 million and things like that. But we have a lot of people who put in like 2,000, 5,000, 10,000, 25, 50,000 as well. So it's just be chilling on their laptop or something. We're getting an app too, so they can just like, I'll make an investment. And so, but you just have to know it. It's real estate investing. People think it's like, sometimes some investors think it's like stocks. So it's not like stocks. Like if you're thinking you're just going to invest in 3 months or 6 months or a year, like you want to get out, like real estate's probably not the thing to do, to invest in for that. Like it's one of those, most any real estate operator is doing like multifamily. It's going to be a 3 to 5 year horizon or longer. Like it's just because you want to give yourself a buffer, because you don't, like right now, people are trying to exit. Like people are like some of these funds that are expiring right now and they have to exit deals. There's an opportunity for people looking to buy real estate. So, it just is not the best time to be exiting deals. And so you just have to educate some of the investors, which I do a lot of. I'll jump on calls for people and talk to them about the cycles.
And I'm sorry, can you go back on the amounts, the investment amounts? Yeah.
So ours is minimum of $2,000. And it kind of fluctuates. I'd say private REITs is usually a couple $100,000, but it's like accredited only. For ours is non-accredited. So like the public non-traded, like there's still some SEC stuff we got to deal with. It's a lot. It's pretty cumbersome as an operator. A lot of things I'm dealing with, reviewing with some of our attorneys. But it's one of those things. So our founder, he and his wife, it's a family office private equity company. They have all sorts of foundations for financial education. So we talked to him about it. It's like, hey, are y'all really sure about this REIT thing? And they're like, yes, because we want to open up. They want to open up higher for everybody, like not just the wealthy people, to have access to high quality real estate. So that's really important to them, just as people and kind of their mission. And so, we're full steam ahead moving forward on this thing.
I think that's a really important point, because again, I think that's kind of where you, again, go back to the analogy of individual stocks versus mutual funds. You can get more diversification with less money in those types of pooled investments. And, it's more indirect ownership. You're not concentrated. Maybe you might not make as much in some cases, but your opportunity to lose more, you got a case of where these things can, if something goes down, it can be offset by something that's also going up. So, again, we get asked the question a lot about minimums because, the fact is that a lot of the multifamily deals do have rather significant minimums to get in. So I think that's a good area of contrast, especially for those who are kind of dipping their toe.
Yeah, and I would say returns are pretty comparable.
Oh yeah, yeah.
I mean, because we have, it depends. It really depends on the duration, deal, cycle. I mean, there's so many factors which I kind of pointed out on there. But I mean, if you're staying in long enough, we've seen some of our investors. I mean, you're making double-digit returns. I mean, our target is double-digit, kind of in the teens, as far as like your IRR goes, and then your multiple. I mean, we're looking for like a 1.8 to 2.3 equity multiple. I mean, that's pretty comparable if you're an LP, just kind of passively riding along an investment.
Good. Anyone else? Oh, Susan?
Communication from what the business and what's going on once you're an investor. And then second of all, in the individual direct investment, you can have calls for cash because there's a property issue that needs more capital. Do you ever see that? Or things of that nature on the REIT side?
Yeah, that's a good question. I mean, so on the reporting side, I'd say we're typically, I might start reporting, over communicating on some things. That's one of my goals I'm gonna try to actually do. But I'd say it's typically like quarterly reports is pretty standard in the market. I mean, they might send out maybe like a newsletter or something occasionally, but I'd say like I'd expect like quarterly reports on that. Is pretty standard in the REIT space. And as far as let's see, and then you're asking about like capital calls.
Yeah, can there be a capital call?
Yeah, I mean with the REIT, I mean you just want to constantly be just growing it because there's always there might be some money kind of coming in and out and things like that. So you want to keep that going. And but then like the more money you just keep, that's why we just want to grow our fund to a certain level. It just gives us more flexibility so we can there's certain deals that we're constantly buying. Even though like there's a deal we're closing on Thursday, we can still, I'm still going to be raising money. I'm going to see if I can backfill because we're heavy on the equity side by just our own. Like we're contributing way more equity than you normally would do as a sponsor. And so we're probably going to backfill some of that out with whatever there's a certain amount we have to keep in the deal. So we're just going to kind of play with that amount. But I'm going to raise money in the REIT and then take some of that REIT money and invest that into this deal because it's a really good deal. As the ones that told Steve about, it's got fixed rate, 3 years interest only, like 5.1%, and it's like, yeah, we're going to be cash flowing pretty well on that sucker. And so I think it'd be a good opportunity for the REIT for sure. But we got other ones. Like we're seeing some of these deals already starting to pop up. Where some of these operators are kind of coming to terms with the reality of the market because there's some deals where we're going to assume some of their existing debt, and we say, hey, this is the price that's going to work for us after doing our due diligence, and they were kind of being hard stance, and so we're willing to walk away. They came back, so we'll see what happens. Obviously, so that we're starting to see those opportunities. I just want to raise money. I'm going to raise funds in the REIT or directly into the deal. I can syndicate some capital and put it in there that way too. So it's just kind of, I'll kind of be looking as like multiple, not just the REIT and not just syndication. I'm going to kind of use like, we have options of different mechanisms that kind of go into our deals. So that's kind of how we kind of deal with as far as like capital calls, I don't think we do a lot of capital calls. We just like, if we have such low leverage on our deals, so we just haven't needed to do that. But some, like where they're higher leverage, like that deal in Houston, yeah, they definitely needed some capital calls just because they couldn't pay their bills, they couldn't pay their expenses.
But it sounds like what you're saying, the REITs hold cash so that they have some cash to handle some existing cash needs of properties they already own. Is that true?
So we, those shares at the end of the quarter, we'll kind of like sweep everything that's been invested, and then we'll just invest it into our portfolio, and we kind of distribute that across the portfolio. That's typically how we how we do that.
Yep. What you got?
I had a question. I found it interesting that you're trying to expand the REIT to like Florida and say,
Yeah.
how do you know what type of real estate you want to buy with the REIT? Like, is it mostly corporate? Is it multifamily? Is it just mainly one type of real estate, or do you divide it and diversify it?
Yeah, I mean, we've mostly been focused on multifamily, but just because of the like the staff and the personnel and the expertise that we have within our group, we have the capabilities to kind of expand in some different asset classes. And so that's why we're just going to do the ones that we got to make sure the economics make sense, the location makes sense for that, all those different factors when we're evaluating a deal. And so so we have some flexibility in our offering circular to where we're not just limited to one asset class. We built in some language in there to help us. So like if we see a great opportunity in another asset class in a different market, we can jump on that opportunity and then hopefully get us a more diversified yield, but maybe hopefully some higher yield. Because I mean, at the end of the day, that's all we really care about is the highest yield possible on our investments and don't lose our money, right? So we don't want to see that stuff that Simon pulled off and that Houston sponsor.
Karen.
So I'm in, I commute a lot. So our headquarters is in Austin. I'm in Southlake. I'm here local. Yeah. No, you're good. Yeah.
I'm going to leave it alone, Karen. You're fine. All right. Well, if there are no other questions, we'll use that as the point to end the formal remarks. Let's give Dustin a hand. We really appreciate all the information. Thank you.
Hey, thank you.
Do you want to lead off deal pitch? Do you, I think you've kind of laid out what you have, but
That's right,
just in case you wanted,
I think I've covered it, right?
90 more seconds, I can put on the clock for you.
I might in a couple. Once we work out that agreement with the sponsor with this other deal we're trying to buy. Yeah,
exactly. All right. So, like I said, with that, we will now turn it over to what we call deal pitching. This is your chance to come up and just introduce yourself and talk a little bit about what you've got going, whether you are looking for a deal or looking for investors in a deal. We'll put 90 seconds on the clock, and I don't even have to look to see who's coming up first. I already see him. By the way, DeLorean, if you want it filmed, we've got people who will do that for you. So all you need to do is ask. But all right, let me get set here.
Thank you.
I guess you can go. This way you get some free time. So
My name is DeLorean, like the car from Back to the Future. I also do apartment investing. We find the deal, we do due diligence on the deal, we manage the deal, and in 3 to 5 years, we look to double investors' money. I also teach apartment investing education, and you can reach me at multifamilyabc@gmail.com or text or call at 214-277-3902. Thank you.
you don't want to keep going? Does that spell anything, by the way? Have you ever looked 214, blah, blah, blah? Does that spell anything? Maybe that's a nice, easy way. I'm going to give you that free marketing advice right here, right now.
I will look into it.
Excellent. Thank you, DeLorean. Always appreciate it. And the thing we love about DeLorean, never takes 90 seconds. Doesn't need it. He's a pro. All right. Hello. Dave. Go.
Hi, Dave Parrish. We are real estate syndicators. I'm with Invest as One Real Estate Investors, and essentially we do new construction and land development. We've got a brand new phase of our duplexes going into South Dallas. So phase 1 is in the process of renting. We're now going to be building townhomes, which are bigger 3 and 4 bedroom units in South Dallas. So we're real excited about this because there's such demand really for new product in that area. So if you'd like to contact me, David P at investas1.com. So pretty simple. Or cell phone, that works, 214-578-1142. Had that number for 20 plus years. So thank you.
But does it spell anything? I'm telling you, I'm giving people gold here and they're just ignoring it. All right. What else we got? Again, this can be for people who are also looking for deals. This is not just people who are pitching deals. And Karen, I don't want to put you on the spot. Yes, I would actually, and for very good reason. So I'm going to introduce a good friend of ours, Karen Maxwell, who is going to talk a little bit about some of the things that she does. That's a little, it's obviously very related, but also somewhat unique.
Unique. Okay, so my name is Karen Maxwell, and I actually hold my monthly meeting for Real Impact Plano. It's a real estate investing group, and we actually hold our meetings here in the Quest office, right here. We just changed it from Saturday to the first Thursday night of the month. So we're actually going to be meeting on Thursday, July the 6th, right here at 6 p.m. And we're going to be talking about, we're going to have Lydia Miller talking about profit first. So for all of you that are looking to get into real estate investing or are already real estate investors, but you need to kind of tweak things about how you're running your business, it'd be a great opportunity for you to come. And it's always a great opportunity for networking. And we always have a lot of exciting things going on. So is that all? 6 o'clock, 6 p.m. Hey, Joe. Was there anything else? Oh, yeah. So it doesn't, I don't know. I've never checked. My phone number is 903-445-6023. And we are working on some things with Wichita Falls. Yeah. So we're going to be trying to do a let's make a deal with Quest and our real estate investor groups, but that's in the future. So I was supposed to talk to you about that, but I was late. Sorry. World Series for 10-year-olds. I was late.
Awesome. Thanks. So first of all, thank you for all the nice things you said about Quest. That wasn't why I asked Karen to come up, though, because I think one of the things I wanted to make a point of with what Karen does, what we do, is that, you know, this is where a lot of the work gets done if you're an investor. And, you know, Nicolette, you know, you're, when is it? Huh? What? You mean this isn't the only real estate related meeting in Dallas? No, I mean, this is like where, again, you meet somebody here, you're going to meet somebody there. You know, it all starts to interconnect, but you know, you never know who you're meeting at one place, who's going to turn you on to another place. And then suddenly you meet Dustin, and then, you know, the opportunity falls into place. So, you know, that's why, you know, we want to cross promote each other as much as anything, because like I said, this is how the job gets done if you are a real estate investor. All right. We certainly have time for one more, but oh, all right, here we go.
Hello, everyone. My name is William Castillo. I am a service provider. I represent a marketing agency. So we work with experienced real estate investors, build their brand online. So, and also being very intentional through social media. A lot of what we're helping people do is raise passive capital, attract passive investors. If you have an offer, like educating real estate investors, we also help you attract people into your programs. Ultimately, building your brand, growing your audience, and monetizing your platform, all through organic ways of doing that. So anyone interested, please connect. Thank you.
Thanks. Okay. Thank you. All right. So I think we're going to use that as our place to stop for the evening. Just so you guys know, we here have pushed our hours back a little bit. So instead of having somebody who's going to kick you out in about 25 minutes, you now have 55 minutes to mill about, and then we will kick you out. So there is food that's left. There is Haley still at the bar. And I don't think all the Dallas Blonde is gone yet, but give us a few minutes, right? I actually stuck one in the refrigerator for you too. Anyway, thank you guys for being here tonight. And again, hope to see you next month for the Luau Link Up is what I think we're calling it. Again, pure networking next month. But looks like I'm cut off now. So with that, thanks again and hope to see you soon. Bye.